Ryan, I just bought a house. I know that you have to put money into escrow when you're, about to purchase the house. But what's escrow from an M&A perspective?
Very similar, contextually speaking. So in escrow, if you think about, it's basically money put aside. So if we want to specifically focus on tax, let's say that a buyer identifies a material sales and use tax risk of the seller. There's two ways to treat it. One is to treat it as a debt-like item in the purchase agreement, which would reduce the purchase price. Another way to treat it is to say, okay, well, we're going to have a tax indemnity escrow. And I think we're getting to indemnifications after this, but what we're going to have is we're going to have a tax indemnity escrow, which is basically going to sit there for 2 or 3 years. And we're going to put a portion of the purchase price into that escrow in case the company is ever audited. And at that time, if the company is audited and they're assessed, any tax, we're going to pull money out of that escrow rather than, go back and try and get the money from you. So escrows, we see these in financial diligence all the time. We have working capital escrows, because you'll have a target working capital, and then, you compare your closing date working capital to that. And sometimes that's not figured out for months after the transaction. So you set up an escrow to withhold purchase price. And then obviously, in an escrow situation, if purchase price goes, if that escrow is released to the seller, it's additional purchase price. If that escrow is never released to the seller, then it's just not purchase price and the buyer gets the money back. But escrows are definitely a way to remediate any historic issues. Putting money into an escrow allows both parties flexibility when it comes to remediating historic issues, especially from a tax standpoint.